All right, let's dive right into this explainer and unpack exactly how the new CEO, Greg Abel, is steering the massive Berkshire Hathaway ship here in 2026. For decades, investors have eagerly awaited Warren Buffett's annual letter just to try and decode the oracle's market moves. But this year marked a monumental shift. We got the first ever shareholder letter authored by Greg Abel. And honestly, right out of the gate, Abel is facing a financial landscape that would make even the most seasoned investors pause. We're talking shifting leadership, a heavily concentrated stock portfolio, and a balance sheet that is frankly defying gravity. So let's just get right to it. To really grasp what's going on, we have to start with the sheer scale of the situation. A record $397 billion. That is how much cash and treasury bills were just sitting on their balance sheet at the end of the first quarter of 2026. Just take a second to let that number sink in. $397 billion. It's an absolutely staggering figure, and it's got Wall Street buzzing and analysts everywhere scratching their heads. You have to ask yourself, why is the world's most famous value investing conglomerate sitting on an unprecedented mountain of cash? Because seeing a mountain of cash that large naturally forces us to ask the ultimate question, doesn't it? Is Berkshire hoarding capital because they see a massive market crash on the horizon? Are they pulling chips off the table because they know something the rest of the market doesn't? It's kind of the anxiety-inducing question on every investor's mind right now. But to truly figure out what that cash means, we can't just look at the numbers in a vacuum.
So, Section 1. The post-Buffett era begins. To answer that cash question, we've got to understand the new leadership dynamic in Omaha.
While the legendary Warren Buffett remains chairman of the board, and yet he's still coming into the office 5 days a week to advise on major moves, Greg Abel now holds full operational control. He officially set the tone by authoring the 2016 shareholder letter. And this isn't just a fancy title change, it's a total structural evolution. Abel is now the guy making the day-to-day calls and setting the strategic framework. It's his playbook we need to decipher if we want to know where Berkshire is heading next.
Which brings us to Section 2, the core business engine. Before we obsess over their stock trades, we need to look at Berkshire's actual operating businesses.
Because it's really easy to forget that Berkshire isn't just some giant mutual fund, right? It's a massive conglomerate of real-world companies. And what's really fascinating here is how incredibly stable that core cash generation engine remains. Just look at this breakdown for the first quarter of 2026. Manufacturing, services, and retailing turned out $3.19 billion. Insurance investment income brought in $2.67 billion. And insurance underwriting? That added another $1.71 billion in operating earnings. Whether it's the railroads, the utilities, or Geico, the diverse engines under the Berkshire umbrella are just operating beautifully. Actually, to put that into perspective, their net cash flow from operating activities hit a massive $46 billion in the previous year, 2025. This absolutely proves the underlying business foundation is as rock solid as ever. They aren't hoarding cash because their businesses are struggling, they're hoarding cash because their businesses are generating it way faster than they can reasonably spend it. All right, Section 3, the 13F portfolio strategy. Let's see how Abel is actually deploying that capital in the stock market. With all that cash flowing in, they still manage a massive $263 billion equity portfolio. And the crucial takeaway here is extreme conviction. Despite the portfolio's immense size, over 60% of it is highly concentrated in just 4 iconic U.S. companies. You've got Apple at 22%, which is nearly $58 billion just on its own, then American Express, Coca-Cola, and Bank of America. This totally flies in the face of modern portfolio theory that preaches endless diversification. Abel is sticking strictly to the classic Buffett model. Find businesses you deeply understand that have enduring competitive advantages and bet big on them.
But don't think Abel is just sitting still, merely managing his predecessor's legacy. In the first quarter, they aggressively increased their position in Alphabet by over 200%. That makes it a nearly $16 billion holding, almost 6% of the entire portfolio. This is a massive signal, you guys. It shows the new leadership is perfectly willing to deploy serious capital into modern tech monopolies when they spot a real dislocation in value.
And this quote, right from Abel's letter, perfectly captures their philosophy. He emphasizes deploying capital into opportunities where risk and return make sense, staying highly concentrated. They aren't looking to buy 100 average companies. They want a few exceptional ones. And if they can't find them at the right price, well, they simply won't play the game.
Which naturally leads us to Section 4, the $400 billion question. Back to the elephant in the room.
Let's break down exactly why this $397 billion hoard exists. Believe it or not, Berkshire has actually been a net seller of stocks for over a dozen consecutive quarters. They've been deliberately trimming positions because they anticipate a potential market peak. But, and this is vital to understand, it doesn't mean they're calling for some apocalyptic crash. It simply means they are patiently waiting for valuations to align with true intrinsic value. Like Buffett has always said, you want to be cautious when others are greedy. And right now, in what they see as an expensive market, Berkshire is exercising peak caution.
Next up, Section 5, the buyback signal. Because just when you think they're completely sidelined, there's a massive twist.
Let's trace this timeline. From 2018 through mid-2024, Berkshire spent about $78 billion buying back their own stock. But then the well went completely dry. For a grueling 21 months, right up to February 2026, they bought virtually nothing. The cash just piled up. Then, out of nowhere in March 2026, they resumed stock buybacks, spending $234 million on their own shares. Now, sure, in the context of a trillion-dollar company, $234 million is a drop in the bucket. But the signal it sends? Enormous. They pulled the trigger because the stock traded down to roughly 1.45 times its book value in March. You see, Berkshire doesn't have some rigid, automated schedule for buybacks. They only buy their own stock when both the CEO and the chairman agree that the market price is at a substantial discount to the company's true intrinsic value. So, dropping to that 1.45 multiple, that was a clear, flashing green light for Greg Abel. And hey, if you need more proof of his conviction, check this out. Abel actually put about $15 million of his own personal money into Berkshire stock at these exact levels. Talk about having skin in the game. When the CEO is not only using company cash but also writing personal checks to buy the stock, it tells you absolutely everything you need to know about what leadership thinks regarding the current valuation.
Finally, Section 6, the final verdict. Let's pull all these threads together to really understand this post-Buffett narrative. The verdict makes one thing incredibly clear. Berkshire isn't necessarily predicting an imminent, devastating market crash. Rather, they're just acting as fiercely disciplined buyers who refuse to overpay in a pricey market. A deal here, a small buyback there, and otherwise, they're perfectly content to just let their cash compound in short-term treasury bills until major, heavily discounted opportunities inevitably arise. And this brings us to where we are today. What's truly fascinating is that the stock is currently trading at around 1.44 times book value. Think about that for a second. That makes Berkshire objectively cheaper today than it was when Greg Abel initiated those buybacks and invested his own millions back in March. The discount to intrinsic value has potentially gotten even wider. So I want to leave you with this thought as we wrap up this explainer. Considering Berkshire Hathaway is currently trading below its own CEO's confirmed buy target, and with nearly $400 billion acting as a massive safety net, is it time for you to follow the playbook? The post-Buffett era has officially begun, but the discipline? That clearly remains exactly the same. Thanks so much for exploring this with me today, and definitely keep your eyes on those upcoming quarterly filings.